Robschild, nothing I say is investment advice. Welcome to the show where we view financial markets through crystal ball gazing. J.P. Morgan once said millionaires don't need astrologers, but billionaires do. And so we begin. Today is Wednesday, April 17th, 2024. I did not find any news or economic data coming out today that I found of any note, of any interest. There were a few interesting things going on in charts today. I want to start again with the S&P 500 on a weekly time frame, each candle representing 1 week. These 3 candles increasing in size, 1, 2, 3, potentially an inverse 3 white soldiers kind of a scenario. Really, we'll see what happens Friday. If this really closes around here or lower on Friday, I think that this spells out for a more confident bear market. I've been saying that this is turning over for a while, and it's been right so far, and it looks for now, for the short term, to be wanting to continue lower and lower with a few little caveats. It's important to remember during times like this that typically nothing moves straight in one direction, and so, with anybody considering any kind of shorting, it's an area that requires a lot of caution, because when you lose on a short, it's so much easier to win on a long than it is on a short, and winning on a short and then also taking your profits and getting out on time is a very challenging situation. I'm still short QQQ, largely because of what Gareth Soloway says on his show. He's a much better chart pattern reader than I could probably ever be. And he seems to be confident right now, from what I see, that he's expecting this continued bear market, again, at least a 10% correction here. Longer term, I've been expecting a much larger correction, and it involves PE ratios. It involves the fact that the Fed's been through a major hiking cycle. It involves the fact that unemployment is going up, that credit card debt is very high. Overall, I see pretty much everything topping out here and wanting to curl over. And so, and again, especially with a short and any kind of very speculative type of position, my max position size is 5% of my portfolio. Going in more than that is, you got to consider your risk tolerance, and you got to be ready to be wrong. Can you lose 5% of your whole portfolio, based on an idea that you are just absolutely sure that is going to be right? If you're okay with that, then 5% is probably a proper allocation size. But yes, it's always very important to be completely prepared for being wrong. In other ways too, if you have an investment that is 40% of your portfolio and can drop by 50%, are you okay with losing 20% of your whole portfolio on that idea as an investment? I mean, can you withstand a 20% drop and say, well, that's going to be okay, I'll still hold it, and when it comes back, it'll come back, if it comes back, and of course I'm referring to here a little bit my own allocation to treasury bonds, because they can drop by half of the value in short term. However, in a long-term scenario, it's they are guaranteed returns, but because of the duration, the value of that fund can fluctuate in the meantime. But as long as rates eventually get back down to a normal range, it's like, I see that as, I'll call it Benjamin Graham related, because it's like the amount of safety is very high, but there's a lot of speculation in the position, that being that as long as rates go down, then the value of that fund goes way up. So it's my favorite opportunity out there. I don't like stocks with enormous amounts of speculative value priced in. I also don't like the stock markets in general right now, simply because of where we are in the business cycle. One of the big rules of investing is don't fight the Fed. It's a very common phrase, and the Fed is trying to kill the economy. And if you are insisting, stocks are going to keep going up, I interpret that attitude as directly fighting the Fed, and I don't think that's wise. I don't think it's wise. Moving on to a daily chart of the S&P 500, we are definitely falling down pretty quickly here. Today was another fairly bearish day. We're down 0.58%, so 0.58% on the day. I wanted to share a weekly chart of QQQ, and I just wanted to, RSI divergences are something that are very worth paying attention to. It's the relative strength index. When you have a lower high, this is one of the most depended sort of metrics that traders will use, right? Like there's moving averages, there's Bollinger Bands, and there's RSI. RSI is one of these very important things to be paying attention to. And when we have the QQQ, the NASDAQ, moving up from June of 2023 up until basically today, and the RSI is not showing a new high here, that's a major, major divergence, and it suggests that this is, on a longer time horizon it's really setting the stage to keep going down here, which adds to my ability to continue to hold my full short position. I haven't even sold any of it yet. If I was smart, we'll see what happens. But typically you want to be like chopping away at it. Like it goes up a little, you take some of it. It goes up a little, you take some more of it, and then until you get to a certain place. I think I am gonna maybe wait for I'll call it a 9% correction. If Gareth Soloway and his crystal ball see a 10%, I'll aim for 9%. I'll be happy with that. SQQQ is a triple leveraged fund, and so you could expect more or less a 30% return on that, and that being 5% of portfolio, overall percentage gain of a portfolio between 1 and 2%, which is great. I've been talking about the Fear and Greed Index. This is from CNN Business. We're still falling here. We had a close of 37 yesterday, and we are currently at 35. HYT, High Yield Corporate. I had noted that this thing looks just like falling off of a cliff, and we have a bounce here. This is not a formidable bounce. These are two little green candles. If anything, it could be short covering. It also, one thing with interest rate sensitive vehicles that is important is you have to pay attention when the dividend is. This is something I didn't point out in any of my videos, but we did have part of the reason for the drop in price. A small part, but on Friday, April 12th, there was a dividend. It paid, what was the dividend? 8 cents. So 8 cents worth of this drop here had to do with the dividend getting paid, I believe. But even without that 8 cents, this is still a formidable drop and continuing down here. And so, we have a little bit of a bounce here. It doesn't look to me like it's gonna keep going up from here. I do see it continuing down, but I'm not betting money on that. Once again, HYT, I only use it as a leading indicator as far as where markets see default and bankruptcy risk in smaller companies and higher risk borrowing, basically. It's a really, really good leading indicator. And it's also, for me, the best place that you can invest in my opinion, in a market capitulation. Benjamin Graham actually talks about this too. He talks about how, in a stock market collapse, if you're looking for safety and return, really, he doesn't call it high yield corporate exactly, but this is his game here. It's the high yield corporate. And if you look at charts and compared HYT to like the S&P 500, the kinds of gains you can get from the bottom of a capitulation, it's faster, it's better. For a short time period, if you can catch a bottom, you'll make a heck of a lot of gains, and then from there, start doing some stock picking as that part of the business cycle continues. Very interesting that the VIX, we had a pretty big drop in the NASDAQ and the S&P 500, day after day after day, and yet the VIX actually dropped a little bit today. And so, if anything, this is suggesting here that the people betting on fear have a little bit of fear on fear. In other words, they're essentially taking some money off of the table here, which is normal when we have movements that are getting a little crazy. If we zoom out a little further on the VIX, this is the straight up VIX. This isn't something that goes up and up and up or down and down and down. It stays within a range. So, for example, in 2017, we had the VIX valued around 10, and the height of COVID, we had it go all the way up to 85, and if I scale it down a little bit, we can see, it's very normal. We frequently throughout history hit around the 20 marker here on the VIX, and post COVID, it seems like we've gone almost to 30 a heck of a bunch of times as well, and we're so much lower than that right now. It's been a very not volatile period, and like I've heard other traders talking about, the longer period you have of peace, the greater the spike oftentimes is. And you can see before some of these biggest spikes, even you see periods of relatively low and long calm periods. But looking at this big spike in 2018, we have this very long peaceful period here, staying below 20 for quite a long time, and then also before this one in 2015. So yeah, literally the million bazillion dollar question is, is this going to turn into another one of these giant spikes? Could this even be like the giant spike of the 100-year cycle of the Great Depression, where you have people jumping out of windows? along with the calming down of the spike, I've been mentioning in a number of very recent shows the VIX Futures term structure, and we are no longer inverted at the front end of this curve here, and I found that to be pretty interesting. And so this could be a leading indicator that this little sell-off is actually already over. And so now that I'm looking at this and thinking through all of this with you, I might have to force myself to get out of a good amount of my shorts this evening in post-market. I'll update. I'll give updates on that in my daily videos. Moving on. TYX 30-year Treasury bond yield. Guaranteed return for the next 30 years if you buy a 30-year Treasury bond. And what is the rate of return? Well, today you could have got 4.7%, which, like I've been talking about on many shows, historically is pretty high, besides the 1970s. And again, I don't think there's any catalyst to have us go into a 1970s kind of inflation. It's fairly well known between pretty much all intelligent investors that all of this inflation that we're getting is because of fiscal spending. The government's spending money, more money than it should be, if you wanted inflation to stay low. The reason stuff's costing more is because the government, they gave stimulus checks. They were pumping out free money for a while, and this is the result. We have inflation. This happens any country in the world that you have anything that seems easy and free while things are actually terrible. At some point you gotta pay the piper, I guess. I'm not sure if that's the right phrase. Anyway, I increased my 40% position in basically the treasury, or the 30-year treasury is a fund called 0Z. But by the way, that's the upside down of this chart for anybody new. When this goes down, the value of treasury bonds goes up, because the same bonds that you bought here that have higher yield, when all bonds are selling for a lower yield, then that higher yield gives your bonds automatic higher value. And so this is an inverse chart to that. But so I increased it actually today to about 43%, I believe. And so I have been talking about going 100% into treasury bonds. The only thing keeping me from doing that is the fact that we still have an inverted yield curve. And typically the worst part of the cycle is after the yield curve uninverts. And so I've been waiting for that. And, is the unemployment numbers are they going to continue to go higher from here? It's not 100% clear right now, and that's the only thing giving me caution right now against going 100% into a fund like 0Z right now. But I am comfortable to have 43%. I'm starting to think that I should aim closer to 50% at these levels, partly because of what Gareth's always been saying in his show about the 10-year note yield. And I'm going to show that real quick. So he recently said that I'm trying to redraw his lines. I can't draw lines like he can. He's better than me at this. He has 25 years of experience of doing charts like a crazy person. But he says, he had people go long TLT. And again, he's more of a short-term trader. Like, he's probably out of that trade already. But he did say as well longer term, and I've been seeing this other pattern here on TNX. Again, when this goes down, the value of bonds goes up. And where is it? All right, so taking a look at a pretty easy pattern to see a shoulder, a head, and if he sees this as the top of the right shoulder, and so do I. And if this turns over, we could see a much bigger decline in yields. Now, well, why am I looking at the 10-year? if you layer the charts on top of each other with the 30 year and the 10 year, they follow each other pretty much to a T. I mean, part of the reason for that is, investors looking into the future, can they really see 30 years into the future? That's 3 times as long as the 10 year. And the 10 year is usually kind of like the longest time horizon that investors try to aim for, being able to predict and see what's going to be happening. So the 30 year, and if you're investing in the 30 year, you get that extra leverage from the higher duration, and you basically have the same you'll have basically the same pattern of yields going up and down. They go up and down together. Part of my short involves shorting semiconductors, because they've just gotten so crazily overvalued, and this is cracking today. So that position has been doing well, and you know, I kind of feel like I have to stay in this trade just because, again, of the valuation problem. You know, when a company is valued at while assuming that it's going to increase the amount of money it can earn by, tenfold, 20-fold, 100-fold, or double its earnings every year for the next 20 years. Like, it's just, the numbers were just getting out of hand, and eventually the markets have to wake up to reality. And this market going down is, for me, nothing more than a little bit of a waking up to reality. Yes, people can keep bidding up the price and holding on to their shares and saying, no, it's worth $1 million a share. But remember, on the other side of that, you need someone to be buying that from you at $1 million a share, if that's what you believe it's worth. And so, anyway, this is pretty much all I have for you today. Again, I'm just thinking about, like, okay, should I be putting more into something like TLT or 0Z long duration treasuries at this moment? And 6 months from now, I might be looking back at today and saying, why didn't you put in more? Why didn't you buy more? And my answer is this to my future self. Cash right now. Okay, so the Fed's coming out now and saying, we're not beating inflation, so rates are going to stay high. And so when rates are high on the short end of the curve, you're still able to get a 4.5% return on cash, sitting in a money market account and a brokerage account. You just have it in cash, ready to deploy at any moment, and it's liquid. It gets historically a very large return from a historical perspective. I mean, cash is not trash right now, as the phrase sometimes goes. And so that's one of my biggest excuses for my future self, who wants to kick me and this time for not getting more treasuries at this time. But the risk is there too. Like, how can I be wrong? Okay, so the Fed is saying they're worried about inflation. I mean, okay, so does that mean we're going to have another wave of inflation? Lynn Alden seems to think that we will be seeing waves of inflation. She had talked about this and calculated this out a little bit, and stating that the amount of fiscal stimulus that we got was so huge post-COVID that it's she says for the whole decade, so until like 2030. So perhaps for the next 6 years we are sitting on higher inflation with these waves of higher inflation. That's kind of her view, and that's where I could be wrong. I see in my crystal ball a little bit more of a normal market cycle. Adding to this the 2007 and the dot-com bubble crash not fully flushing out bad credit, which it didn't. And if we actually do finally flush out all the bad credit and go back down to a normal historical low PE ratio of around 7 in the S&P 500, it's like it's not unreasonable to expect an 80% decline in the S&P 500. Sounds shocking, but it's like it's not out of the realm of possibilities, and I don't want to be on the wrong side of things when that's happening, for sure. Especially again when treasuries and money markets have such a secure return. It's like I'm comfortable where I am for the most part. That's all I have for you for today's show. I hope you enjoyed watching. Thank you for watching, and see you next time. Robschild.